Well, thank you very much. It's truly a pleasure to be here, and I have to say thank you if you were woken up at 5:30 that you're still here. So we really appreciate your attendance. So we'll get started. This is the fine print. Even though in my past life I've been a broker, I am no longer a registered broker, and as an employee of CME Group, I cannot give you trading advice, and I cannot tell you where the price of lumber will be in 6 months. So you should ask some of the other folks who are going to be up here after me. So what I will talk about today is the CME Group history, for those of you who may not be familiar with us, what futures are, and why it's important to use risk management tools. I'll talk a little bit about something specific to lumber with our contract, but the most important thing, because I only have 20 minutes here, the most important thing is what are your resources and how can you reach out to us? Because if you have questions, we really want you to be in contact with us after today. So, who is CME Group? We are a collection of futures exchanges. So, most of you are familiar with the Chicago Mercantile Exchange. That's where lumber has traditionally been traded. But we also have the Chicago Board of Trade, which has grains and oilseed products. We have the New York Mercantile Exchange, which is traditionally an energy commodity exchange. And we have the COMEX, which is a metals exchange. In addition, CME Group has financial products, equities, interest rates, and so on. I'll talk a little bit more about CME history. So it really all began in Chicago in the mid-1800s. Chicago was a transportation hotspot. We had rail lines, there was, river traffic, and we also had great communication with telegraph lines at the time. So it became the spot where people would negotiate commodities trading. So CBOT, the Chicago Board of Trade, became the first futures exchange in 1848. In 1919, the Chicago Butter and Egg Board became the Chicago Mercantile Exchange. More interestingly for this audience is that in 1969, we launched lumber futures. So I personally wasn't around, so I don't know if anybody can vouch for this, but this top picture here, supposedly on the first day of lumber futures trading, there was no bell, they had an artificial tree, and a lumberjack chopped it down, and that signified when futures could start. Just the first day, we don't still do that. In 1987, we launched lumber options, and in 1992, we had our first electronic trades on CME Globex. So as many of you know, there's been an evolution through the markets, not just lumber, but all markets, where things have moved gradually over time to electronic trading. In 2008, lumber futures and options were added to that electronic platform, and in 2015, pretty much all futures became fully electronic. So, what are futures? This is a lot of text. I'll go ahead and read it, but then we're going to take a moment and step back and kind of dissect the parts of this. So a futures contract is a legally binding agreement to accept delivery or make delivery of a standardized quantity and quality of a commodity to a standardized place during the specified time period for a price discovered on a futures exchange. Okay, that's a lot of text. Take a step back, we'll talk about the evolution of it. So remember how I said Chicago was the transportation hotspot for commodities? So it kind of began with grain. So grain farmers would come to Chicago and they'd meet up with a grain buyer. And they would immediately say, look, I have grain, I want to sell it today. That's called a spot market. That's immediate delivery. Then, over time, these buyers and sellers started to say, you know what? Why don't we do this transaction, but let's do it a few months from now. So that became a forward contract. And then it evolved even further. It started to become standardized. So people said, you know what? Why don't we do a contract? It's always going to be this amount in a minimum quantity. It's always going to be, these set delivery dates. And we know the quality and we know exactly where we're going to make delivery. It made it easier for people to negotiate. And then, when you had that very standardized set of contracts, more people started to enter the market. So instead of just the grain seller to the grain buyer, you started to have professional traders come in the market. People who knew that they could buy or sell these contracts and liquidate them before delivery. These people entered the market for the purpose of profiting, or speculators, and they added a very important purpose. They added liquidity to the market. So this is the lumber futures contract. So these are your standardized specs for your industry. One of the things that we want to talk about with the industry is, are these the right specs? Do we need to revisit them? We're very open to that. So again, please reach out to us. We're very happy to have this conversation because we want the best contract specs for the industry. Now, we've talked about what a futures contract is, how it evolved, what the standard specs are, but what makes it so special to trade on an exchange? So an exchange provides a very important purpose. An exchange is a central counterparty that provides clearing services. So a central counterparty, what that means is rather than me having a contract directly with somebody, the exchange steps in the middle between us. So the exchange is the buyer to every seller and the seller to every buyer. So it doesn't matter who I trade with because I know ultimately my trade is with CME. But you also know that CME isn't holding a position. They're flat at the end of the day. So this is very important for liquidity and trading purposes. You don't need to worry about your counterparty's creditworthiness. And there's not many instances in life where we don't need to worry about that. Another thing that an exchange does is we adjust trades daily. So this is something that helps mitigate risk. If you have a big price movement over a sustained period of time and somebody hasn't been making payments along the way, how do you know that they're not going to default? So the exchange, some love it, some don't like it, but what we do require is we require something that's called a margin payment. You put down, basically it's like collateral, and as the market moves, either in your favor or against you, we may either ask for you to send money or you will receive money back. All that money represents is your position and the unrealized value of your gains or losses. Once you close a position, that money is returned back to you. So, and finally, one other thing that an exchange provides is price discovery. Even if you aren't trading futures or options, I am guessing that most of you are looking at the futures price. It provides a benchmark to the industry. It's open and it's transparent. That's another key benefit of seeing an exchange. So this is just our front month lumber futures price. Okay, why is risk management important? Perhaps I'll take a moment and just ask, how many in the room have ever used futures or options tools? This is the perfect audience then. So, this is why people should look at risk management. Lumber volatility is tremendous, and this is historical volatility. Oftentimes, the market will price in a higher volatility. So, we would like to think price may be going one direction, but we might not actually know. And this volatility chart really can show that you might get hurt if you're not managing that risk. So let's talk a little bit about how to manage this risk. I'm going to be very general because, again, we only have a few minutes here, but you can follow up with people later. I'm not going to discuss options. I'm going to stay with futures for this talk. So futures markets are used as a way to hedge yourself against adverse price moves. So let's say I own inventory. My risk is that before I can resell that inventory, the market does what? Goes down. That's my risk. So what can I do if the market goes down before I can resell it? Well, I can take a short position. That means I can sell a futures contract in the market. And just in case you don't know, yes, you can sell before you can buy. So you can sell a futures contract. Now let's say I'm the opposite. I need to buy inventory, but I don't have a purchase locked up yet. What's my risk? That price goes up. Exactly. So in that case, I need to buy a contract. So you see, what you do in futures is really a proxy for your future cash activity. It's a way to help protect yourself. So if one position goes up, the other position goes down. The intent is not to make money on both sides. The intent is to offset your risk. So I'll go through a quick example on a short hedge. So this would be somebody who is long inventory. Oh, and one quick note. So basis is cash price minus futures price. I won't say I'm an expert in lumber basis. There are people in this room who are. So this example is more meant for demonstration purposes. So let's say we have inventory today. It's valued at $360. Let's say the futures are at $375. This means that my position, if I take cash price minus futures price, I have a 15 under position if I'm looking at basis. So to hedge myself, I now sell futures, and let's say, so yes, I'm sorry, I'll go back. I own inventory at $360. I've sold futures at $375. So let's say time passes. I now sell my cash inventory. Price has dropped on the cash side by 30 cents. So I sell it at $330. But I buy my futures back. Futures have also dropped by 30 cents. My basis position has not changed. I am still 15 under. So let's look at the hedge result. On the inventory side, I lost 30 cents. On the future side, I gained 30 cents. In this case, the futures and cash positions moved perfectly together. My net hedge position is 0. And why is it 0? You can do the same math by just taking the difference in the basis position. So negative 15 did not change. It's still negative 15. There was no change in my basis position. And you can see that the hedge result was I perfectly hedged. Now, sometimes cash doesn't move perfectly with futures, but it can often still be wise to look at risk management. Again, I'm not giving you trading advice. Talk to brokers. Let's say we've got our inventory at $360. I sell futures at $375. Again, I have a short basis position at 15 under. Now, let's say time has passed. Now my cash has dropped more. So I sell inventory at $320. I buy futures back at $345. My basis position, cash minus futures, is 25 under. My hedge result, I lost 40 cents on the inventory. I gained 30 cents on the futures. My net hedge position is at negative 10. But let's think about this. If I hadn't hedged, what would my position be? I would have lost 40 cents. By hedging, I reduced that to 10 cents. So not perfect. They don't always move perfectly, but people should strongly look at risk management as a way to help manage their margins. Talk a little bit about efficient commodity allocation. I understand in lumber, you can't store product for tremendous periods of time, but futures spreads tell the market something. They send a signal. So what this is we have multiple futures contract expirations, and this chart is giving us the settlement price for those different expirations. So if I have, and this, I believe this is from Friday, if the May future is at 376 and the July future is at 383, depending on what it costs to store over those months, the market is actually saying, they're sending a signal. They're saying, we're willing to pay you money to store your product for a period of time. Now, we can see markets do the opposite. So again, I'm not sure of your storage cost, but if you've got a nearby month that is higher than a deferred month, that is a signal that the market is sending that says, we are not paying you to store, we're demanding your product now. So when you're talking to brokers about risk management, it's important to know what these spreads are doing as they send market signals. The This is just kind of a graphical representation of our delivery area. This is something that we are very interested to speak with the industry about, as we have heard some people say we need to be considering either an expanded delivery area or different species. We have to be very thoughtful about this, but again, please reach out to us if you have some specific feelings on this. I've also heard some people say, does the contract really represent an Eastern mill? We did some quick correlations, and this is using random links data, but there are some very high R-squareds for correlation. So from a price risk management, even though an Eastern price might not look like a Western price, the correlation between the two is very good. So this, certainly, usually would qualify for hedge hedge treatment. And I'll talk a little bit about the elephant in the room. So over time, CME Group lumber futures volumes have declined. Our open interest has declined. We want this contract to be healthy. We want people to be able to use this as a risk management tool. So we are very interested in talking with you if we need to make improvements to this contract. So finally, I'll finish up by talking about some of the resources available to you. One is we are putting together a directory for people who wish to communicate about trades prior to executing them on the screen. This is allowable under our rules, but you should understand what those rules are. The people who we've placed on our directory have all had conversations with market regulation to understand how those rules work. If you want to know how this works, reach out to us. You can also reach out to the people on the list. We're happy to follow up and send this to you, but this should be on our website shortly. I also want to bring up CME Direct. This is actually a free front end that we provide for people to see and trade futures markets as long as you have the permission of your clearing firm. We also have a daily lumber report. It's pretty simple. We don't give any commentary, but if you want to see closing futures prices, if you want to see the forward curve, we send that out every morning. Again, reach out to us. This lumber@cmegroup.com. That's a general email that can reach myself as well as some of my research and sales colleagues. So thank you for your time. We appreciate it. Thank you.
Thank you very much. Stick around. We'll just see. Are there any questions for Candice this morning? Des questions? Pas de questions? I have maybe just a quick question. I was just curious, and I know you can't get into the specifics of who does what, but in your opinion, how many of the producers in Canada and the U.S. use this tool? Are we talking about 10% of the producers or 50%? What's your take on that?
So I can't actually see customer data because there's a regulatory wall. So anything I know is based off of just what I'm hearing. What I'm hearing is that people, if they are using them, aren't fully hedging themselves. So even if you are a user of risk management, perhaps you're not doing it to actually fully cover your risk. So it sounds like even if we had people to, up their risk management by even 10%, it would really make a meaningful difference to the contract.
Thank you very much, Candice. Thank you for your time.
Thank you.
And on continue la matinée.